Welcome back to a new real estate roadmap podcast with Chris Cusimano. And today I got an awesome guest here. So I'm going to introduce him in a second, but let me give a little context here. I have been in real estate since I was 19 years old, and I'm now in my 40s. And I can't believe I said that. And for the longest time, it's really hard to find a real estate broker that you can call a partner. Now, there's a lot of good real estate brokers out there, but this guy today just has it. He gets the social media game. He gets how to build a business. He gets how to delegate certain tasks and scale, and he gets how to treat real estate agents and other brokers. And I've known from him for quite a while now, and I do quite a bit of work with him. And he has some really good, interesting takes on mortgages and things of all sorts of tips and tricks for home buyers and sellers actually in this market. So I figured let's have a conversation. With that, here's my man Brandon Brotsky. What's up, Brandon?
What's going on? How are you, Chris?
I'm good, man. How are you?
I'm good. Thanks for having me on.
I appreciate it. So I gave you a little bit of introduction. Was I accurate? Well, you can't pat yourself on the back too much, but how would you
Yeah, I
describe
mean, I,
yourself?
I, I mean, it sounded accurate to me. I'm the best. I mean, that's as about as accurate as it gets. No, yeah, I thought it was fairly accurate. I mean, like you said, my story is similar to yours. Actually, you started when you were 19. I got in the mortgage business when I was 20 years old, so I've been in it for a while. Um, I dropped out of college actually and started in the mortgage industry. I thought I was going to take a little time off of school, but that little bit of time has now become man, to almost 23 years this month, actually. So become a very long time. And I never went back to school, but I found something that I really enjoyed and I was good at. And I always liked, working with people. And over time, I figured out, how to help those people and things that I can, continue to strive to become better at. That helps people, whether it's a real estate agent like yourself or it's our clients. I really enjoy the time I spend working with you and people like you and clients alike. And so I just found something that worked for me. That doesn't necessarily work for everyone. And now what I do is you mentioned social media briefly when you were talking about me in your intro, but I've always enjoyed educating others on how to save money, how to make money pertaining to real estate, and I've taken that onto social media as of 2 years ago, and it was able to just get to a broader base. Previously it was pretty limited to a room full of agents or just a phone call with a client or maybe a Zoom call with a client, right? So I was able to bring it out to the masses and provide the same information at scale, which is awesome, and I really enjoy doing it.
Man, you there's a lot to unpack there because you just opened 20 doors that I want to go down. So we're kind of jumping the gun a little bit. He mentioned social media, so did I. And he doesn't necessarily know this, but because of his social media feed, I have a bunch of questions I'm going to rattle off later that I think I'm pretty confident, hopefully, that it'll be the answers would be pretty exciting for everyone listening, or at least interesting at the very least. But I didn't know you did mortgages since you were 19. Ironically, I was doing mortgages before real estate or simultaneous to real estate. I can't recall so long ago. And I tell you what, Brandon, one of my regrets, and I know the grass is always greener, is that I didn't stick with mortgages in that I jumped into the real estate space. And the reason why I say that real quick is not that I don't love real estate. I love what I do and I love it. But real estate sales is very much on the road, on the go, nonstop, right? When you're in mortgages, I don't know if this is a good thing or a bad thing, but you don't have to drive to show houses or go on listing appointments. You do all your work from where you're at. I don't know if that's like a depressing thing for someone like you who's very social, but for me, I don't know. I kind of think that's kind of cool. You can basically go anywhere and do mortgages now. I can't move my
Yeah,
business
it's true.
from where I'm at. I can't just move to, like, I don't know, Arkansas. It just start doing real estate. I can, but it's going to take a minute. You could probably just pick up and start doing mortgages right there. Just get a license
Yeah, it's
there.
valid. I mean, yeah, I guess it's a good point, right? I do business in 8 states, so and I'm obviously only in one, and so that's a good point you just made, right? For what I do, you know, although it'd be nice to have that face to face interaction with the clients and with the realtors, it's just not a requirement for my part of the business. Yours is certainly different as the agent because you're the one who's taking them to see the homes and walking them through those homes. And really, you need to build a different type of relationship with your clients as the agent because they're taking a different type of advice from you. Their end decision on the property they decide to move forward with is heavily based on the value and information that you give to them when you're interacting with them in person. My job is to make sure they're comfortable with the payment that comes along with that property and the amount of money they need to put into it and thinking long term, not just short term. And so my conversation is easier had over the phone or on a Zoom call, where I feel like your piece of it has to be in person. So to your point, yeah, you don't have that same level of flexibility on the real estate side that I do sitting at a desk.
Yeah, it's very interesting too on the real estate side. Even though I have pivoted quite heavily to Google Meeting presentations or even like Looms or Camtasia recordings. As a matter of fact, last night I did a follow up presentation for someone who wants to list two properties by FAU, and it was all recorded. And they called me today. But even though that's a possibility with today's technology, for some reason, um, well, I kind of know the reason, but a lot of people want to meet their real estate agent face to face. You don't necessarily need to always, but that's like a thing. And I would say that as a mortgage broker, going to you before a real estate agent is ideal, but they think of us first. And I think they go to us and they want to get face to face and get comfortable. But then once they're comfortable, they're pretty okay with our referral partners and they're just good with a phone call. Right. I don't
Yeah, I mean,
know.
I think that's just it. I mean, they definitely come to you first. I mean, it's rare to meet some, although in reality, they should start by finding out what they qualify for naturally, right? To go out and start looking at properties and getting excited over a property that may not ever, nothing may ever come to fruition because you may not quite be qualified. Maybe not just income wise, but maybe there's something you need to work on your credit, right? There could be a multitude of things that could cause someone to not be able to qualify for a home that they want. But yeah, I mean, they always want to start with the house because that's the, the sexy part,
Yeah,
right?
it's sexy. It's fun.
No one wants to talk about what a mortgage payment's going to be and how much money they need to come out of pocket. They want to talk about the end result, which is the home that they're going to be moving their family into or themselves into, and they're going to start whatever it might be, right? Everyone has different aspirations for what they want to do when they buy a home, but that's the fun part is buying the house,
Yep.
shopping for the house, right? It's like anything, shopping for anything. The fun part's the shopping for it, not the paying for it. I'm the paying for it part. You're the shopping for it part, right? And so it's just a completely different dynamic that you have with your clients, right? And so the face to face, I think it's extremely important. Now things are going to change as time progresses. I think that's a huge piece of social media and building trust, right, with your clients where you don't necessarily have to be face to face, but at least right now in the market, I think that agents like yourself, those that take the time to meet with someone, are the ones that are most successful, right? Rather than just looking for ways to not have to do that.
Yeah. Um, I learned on earlier in my career, and if you're a new real estate agent, don't fall for the same trap I did. Is that when you'll get a very motivated, excited buyer, and you try to explain to them, "Hey, you got to get pre-approved first," and they do it, they push back a little bit, and because you're so worried about losing the sale, and you haven't had a lot of transactions on your belt, you're like, "Okay, I have a bird in the hand, right? So I'm gonna just do what they want." And then finally you spend 7 8 weekends with them and then you find a house and then you go get them approved then to find out they can't buy anyways, right? That has happened to me early on in
Yeah,
my
and
career,
you know what?
you know.
You always wanna make it about the person, not about it's never about us, never about you, Chris, never about me or anyone
Of course
listening
not.
on here if you're a real estate professional. They want they should really wanna put themselves in the strongest position possible. So by taking your advice on getting pre-approved, it's not because you don't wanna spend the time going and showing them properties because it's your time, although your time is valuable naturally.
Yeah, sure.
You don't wanna set them up for failure. And so, for
That's it.
one, right? They may qualify for more than they realize. Or, like you said, they can qualify for less or not qualify at all. But the most important thing is to find that out up front, not after the
Yeah,
fact. So, want to put them in the strongest position possible.
yeah, you don't get time back. They don't get time back. And when people hire you as a real estate agent, they hire you to guide them and be a leader. These things take time to learn as, especially when you're younger, when you first start and naive, but they're literally hiring you to take control for them. That's why you're there. So take control is what I tell my agents and my coaching clients. Just take control of the situation. No, this does not make sense. It's the cart before the horse. We can see a bunch of houses. It's just not in your best interest to do that because you may or may not afford this and you may or may afford more. You may or may not have a tax burden you weren't considering. You may or may just not understand all of the things that are involved in buying a house. There's principal, interest, taxes,
Or even,
insurance, and all
I
that
mean,
stuff.
there's all that, right? Those are all valid points. And how about just what if we go out, you fall in love with a house, and so does someone else, but that someone else is already pre approved and you're not?
Oh, yeah. Good
They're
point.
they're in a stronger position, right? So why would you not, if you're serious about wanting to buy a house, and I always say something when I talk to a client, if you're truly considering doing something in the next 4 months, then it makes sense to get pre-approved because that's the length of time a pre-approval is good for. And so if you're going to go out and look at properties, you're not just doing that for fun. I mean, maybe you are, but I imagine you're not, right? If you're serious, you're going out because you're hoping to identify the property that's right for you and your family. And you're going to want to make a move on that property once you find it. The last thing you want to do is be in the weakest possible position and not be qualified.
Yep.
Not that you don't qualify, but just not going through the process of being qualified up front, right? The pre-approval process. At least you know once you find a house, you can pull the trigger. You don't need me to just tell you again, yeah, you're good to go. I'm happy to run numbers. I do it all the time. But the point is, they find a house that checks all or most of the boxes and they have a pre-approval letter in hand. Chris, you or whoever their agent is can go ahead and drop that contract, get that offer submitted. You're not having to wait on anyone else to do it. Time kills opportunity.
All
So,
day long.
if right? And so that's the bigger thing is that that's where you want to kind of point it out is, hey, I want you to be in the strongest position possible. And by being pre-approved, that's how you get in that position. And here's why. We know that this market's going to shift. Maybe right now there's less competition on the same homes. But as soon as we see those rates come down, right? Whenever that might be, whether it's next month, the month after, 6 months from now, that part's irrelevant. But what we do know is when it does happen, it creates more competition in the market because lower rates create more buyers. You're going to have buyers that thought rates were too high that are now back in the market, buyers that didn't qualify because rates were too high that are now back in the market. Now combine that, right, with the people that were already in the market, and then you have the same amount of inventory or maybe a little bit more inventory, but where the inventory is not moving at the same pace as the number of buyers entering the market, it's going to drive prices up. And so now you have more competition on the same homes, probably not to the degree we saw around COVID. But when you're competing with at least one other buyer, right? Maybe not 50, but at least one, the strongest buyer wins. And the person who's qualified is going to be the stronger buyer. And so that's
Yep.
what's so important to know.
Yeah. I'm gonna take this conversation a different way than I was a second ago because of what you just said. But I want to say something first is that as a listing agent, primarily, it does happen when offers come in and the buyers are not even approved yet, and you always say, okay, so where's the pre-qual? Where's the pre-approval? And they're like, oh, we're working on it. And you're like, right there is kind of a red flag. Because you gotta understand, as a listing agent, we have a fiduciary responsibility for our client to make sure that their assets and which there's a huge umbrella that encompasses so you have to make sure that they are fully protected. And when someone comes to you and is like, yeah, I'm not really too sure if my client is ready, you're kind of like, what? How do you get this far in the process? So it's concerning about the seriousness of the buyer A, and also the experience of the real estate agent. And you're just like, because those things matter in a complicated, high price point in highly leveraged situation. You got to make sure you're on your game, and you got to make sure that your clients are protected. So the direction that I decided to pivot to was, you were talking about prices. I mean, rates going potentially down in the next couple months. And you said 1 month, 2 months, maybe six, you don't know. And no one knows. But what's your feel? What's your take? What's your in talking to your mortgage people?
I think that once we see a new Fed chair in place, I think that just not that it's going to necessarily have a direct impact on interest rates because the new Fed chair comes in. The Fed doesn't necessarily determine what happens with long term rates, right? Mortgage rates. But
Sure.
we know realistically, whoever gets put in that position is going to be someone who's apt to please the president, right? And be in line with his thoughts on where rates should be, right? And he very clear, he thinks rates should be lower. And so just the feeling behind that, the perception of whoever is going to be put in that position is going to help bring rates down, I think is going to cause rates to drop. I'm not talking about rates dropping down to the fours. I'm thinking, we'll see rates with a consistently across the board with a 5 in front of that decimal point rather than a 6. And that makes a substantial difference mentally for people. It happens at, rates are in the low sixes right now. They're low. They're not bad by any means. I mean, when I got in the business, I mentioned it was a long time ago. ARMs, which are adjustable rate mortgages, were in like the low to mid fours, but fixed rates were in the fives. And
Sure.
so, right now we're low sixes. We're pretty close. Government loans, so FHA, VA are in the fives. We're not far off. So it's not going to take much movement, half a point maybe, in rates. And I think we're going to see a lot of movement when it comes to buyers. So my prediction, and it's only a prediction, it's certainly, don't take this as gospel by any means. I think that we'll see rates drop below the 6% threshold across the board around April.
Yeah, no, I don't disagree with you there. And also I think there's just this mindset of people just for being in the biz for a bit and talking to lots of potential buyers is that that 5 is a powerful number, even if it's like 5.9, right?
Yeah, of
That's a
course.
powerful number that people are kind of waiting on. But in the grand scheme of things, if you look at rates over the history of mortgage rates, 6.25 is not bad at all.
Not
It's
at
just
all. It really isn't.
we just remember 2 and 3% from COVID. You know what I
Well,
mean?
that's a problem, right? And so it's almost like you need to wipe that from your memory because that's completely unrealistic. I mean, there was a global pandemic that
Hopefully
created the
that doesn't
need for
happen
that.
again.
Yeah, right. Hopefully not in our lifetimes, right? And but like it's almost like you have to take that period of time and just completely delete it, right, from memory and look at before that and look at now. Rates are down from where they were post COVID. I mean, rates were in the mid sevens.
Yep.
So everyone focuses on the lowest rates. Why not focus on the height of the rates within our time period where we might have been looking to buy? Not where oh man, rates were at 2.5% in 2021. How about look at Man, I'm so glad I'm looking to buy right now because rates were at 7.5 at the end of 2023. And so, man, I'm so happy I'm looking now. Rates are 1.25% lower than they were a year and a half ago. It's
Yep.
everyone focuses on the low rates, which are not realistic. The higher rates are more realistic. And so it's almost you got to flip the mentality and flip the psyche behind that. But I think it's gotten better. I mean, I will say, mortgage applications are up substantially rolling into 2026. And that's a positive sign because
Yeah.
this time of year, holiday time, which is obviously when we're speaking, a week before Christmas, right? This is usually a slow time of year for mortgages, right? Because we're directly impacted by real estate transactions. So when realtors slow down, mortgages typically slow down, but we're seeing a lot more influx of mortgage applications than we have in the past years. We track all that information. So I think we're going to see a strong 2026 just because more and more people are just getting acclimated to the fact that this is where rates are. And I want to take advantage of home prices where they are today before rates do come down further and it causes home prices to increase.
Yeah, and the thing with that is that when rates do go down, that means competition goes up on the buyer side. And when competition goes up and demand goes up, then what happens? Prices go up. So
Exactly right.
it's a question 22. It's a catch 22. It's either higher rates or higher prices, or there's always a pro and a con. And also with that, you're gonna tip. So most situations where people sell a house and then buy a house, right? They have to go somewhere, and usually it's locally. At least in my experience, not always, but you're gonna have to buy in the same market that you sell and sell in the same market that you buy. So I always say, well, just pick the time that makes sense for you. Because if it's a buyer's market, you're gonna sell in a buyer's market. If it's a seller's market, you're gonna sell in a seller's market, right? If you sell and buy in a seller's market, it's the same market. So it's not like you're gonna sell in a seller's market and buy in a buyer's market. You can't time the
Yeah.
market. It's impossible. Um, well, I had another point I wanted to mention on that. It was a solid point, and now I forgot it. Oh man! But we'll just lean into the next part of this because the question I wanted to ask you earlier, you were talking about certain types of buyers and get pre-approved and whether they should get a loan or not, and don't waste your time looking for houses because they might not get approved. Is there a time you can walk us through where you got to tell someone no, like no, you should not get a mortgage? They can technically get approved, but maybe they shouldn't do it. It's probably not the best thing for them. Has that ever happened?
So I technically can't tell someone that specifically because if someone qualifies, I have to let them know they qualify.
Oh, that's
Uh,
interesting.
yeah, I can't now if they ask me for my personal opinion, I can always give a personal opinion technically, but I'm not supposed to deter someone, right? But what I can tell you is there are situations where someone may qualify, typically with condos, right? For example, so I just had a client this past week where they were purchasing a condo. They were under contract, going through the whole process, and you know, for those that are newer realtors on or even experienced realtors, you might not know, or you may know that condominiums are substantially different than financing a single family home or a true townhome because the condo itself has to meet specific lending requirements in order to even get a mortgage on it. And part of that process requires us as lenders to get a condo questionnaire completed. And, it looks at the budget, it looks at the bylaws, the master insurance policy. But another piece that we look at as lenders, not just us individually, but lenders across the board, has to do with any sort of structural integrity issues. Right. So since the building collapsed in Surfside a few years ago, this was added on as part of the process when a condo is going through the financial approval process for someone buying in there. And so this particular borrower, we got his condo questionnaire back, and it said that there are currently some structural issues and they're doing work on it, and it will be completed in 2027. So that's an immediate stop for a conventional mortgage, right? Your typical Fannie Mae, Freddie Mac back conforming conventional loans that most people on here probably are familiar with. If there's a health and safety related issue and it's still in process of being fixed, you cannot get a regular conventional mortgage in the building. And so we let him know, hey, unfortunately, we can't go this route. You're not going to be able to qualify. This building's just not eligible for traditional financing right now. We did let him know that there's non-QM, so mortgages that are not being sold to Fannie Mae or Freddie Mac, right? That don't look at the same things or don't have the same requirements, are a little more lax when it comes to that. But what I did explain to this borrower, so this is kind of not turning him down for the loan, but just explaining my thought process on this, is I always say this, and this is condo specific. If it's this difficult for you as a borrower to purchase this unit, you need to think, if I'm not happy in this condo 6 months from now, a year from now, whatever it might be, what's the process going to be like for me to sell this property
Good point.
to a future buyer? Because if I'm having to jump through different hoops, I'm having to use some non-traditional mortgage with a higher interest rate, higher down payment requirement because of this, how difficult is it going to be for me? Is it going to limit my buyer pool to cash buyers and only those that are willing to kind of look past what's being done? So that kind of answers your question, where it's not necessarily, hey, you qualify, but I don't think you should get a mortgage right now. But a situation like that, where it's more property specific, I'll give my thoughts the same way I just shared them with you. That's exactly how I shared it with him. He ended up deciding that he wasn't going to proceed with that property and he's looking for other properties. But that's the way you have to think. And we try to convey that information to the borrowers, right? The buyers. And I think it's good, even as realtors, I think it's good information for you to have. The more difficult, just we'll talk about property type, the more difficult it is to obtain financing on a property, the more difficult it is for someone to sell that property. And although when you're buying something, you're not necessarily thinking about selling it unless you're flipping a property, right? You still want to think about it, right? You don't want, you want to limit the friction for someone trying to purchase the property.
Sure.
And so you just want to have that mindset as an agent when you're conveying information to your client. You don't want to just try to constantly shove that square peg in a round hole. Just because there's something out there that can help get it done doesn't mean you should get it done.
Yeah, well, you
Sometimes it
should
makes
never
sense to move
operate
on.
that way. You
Yeah,
should,
agreed.
as a professional, you should never operate that way. Let's be real. There people do, and you shouldn't. So condos in general are pretty challenging for realtors and for mortgage brokers for the reasons you just mentioned. But I want to ask you about condo questionnaires. Okay, if you get a contract handed to you with a pre-approved client of yours, it's a condo. When do you typically order the condo questionnaire? Do you do it right away or do you wait?
Yeah, immediately. But what we try to do to just be proactive and avoid even having someone go under contract, right? Is if it's a realtor we do business with on a regular basis, they know that our process is for the realtor to send us the name of the condo building that their client is interested in, and we can check that against Fannie Mae and Freddie Mac's approved condo list before you ever submit an offer. Now, that's not like solving every problem, because you might have a condo that isn't even on the list,
Yeah.
right? Whether it's approved, and just for those who don't know what I'm referencing, Fannie Mae and Freddie Mac track any condo they've done a review on, and they list it as either approved or ineligible. Approved means it met all lending requirements. Ineligible means it didn't, right? Many reasons why it doesn't. The budget didn't make sense. The master insurance policy doesn't have the proper coverage. There's structural issues, right? But a lender, not just us, any lender, your broker, whomever, should be able to check that for you before you ever submit an offer. And so if it turns out that the building is on that list, if it's approved, that's awesome. You're good to go. Like there's nothing to even think about being an issue, right?
Yep.
If it's on the list and it's ineligible, you need to move on to a different property and not even go through the process on that. But let's just say it's a realtor we don't like. In this case, this was a realtor we don't have a relationship with. The client found me online, right? So it's a different process outside of when it comes directly as a referral from one of the agents I ever like yourself, right?
Yep.
And so we request the condo questionnaire immediately. So part of our process when we get a client under contract, just so you understand what happens, first thing they have to do is sign loan disclosures. Loan disclosures are essentially them saying, hey, I'm proceeding with this process. One of the documents called an intent to proceed. Doesn't lock them into having to use us, right? People decide sometimes to switch lenders, whether it's us or someone else, halfway through the process, right?
Yep.
But what it does do is it allows us to work on their behalf and do the necessary steps that we have to follow, right? So once they sign that, which is quick, it's electronic, we order the condo questionnaire, title work, and then the appraisal if that's something that they want us to order or the realtor wants us to order. Some realtors like to wait until after the inspection, right? The inspection period. Others want us to order the appraisal right away. But that's part of the third party services that are ordered at the very beginning of the process. Now, a lot of these condo associations can take a week, sometimes longer, some are fast, right? It just depends to even complete the questionnaire. A lot of them charge to do it,
Yep.
right? And that's a cost that your client, as a realtor, your client incurs that cost, right? They're the ones who have to pay the condo association or the management company, whoever it might be, to go ahead and complete that. But that was just a very long-winded answer to your simple question is when is it ordered? It's ordered
But
at
you answered it.
the very beginning because you want to get that information back. Any information that we can't obtain, right? I can look at someone's credit report. I know if their credit's good. I can look at their bank statement. I know if they have money. I can look at their pay stubs and W-2s. I know they have income. What I can't do is I can't look at what the condo documents look like without actually getting them from the condo association with the questionnaire. And so that's why it's so important that that's ordered early on because you're relying on a third party to complete something that dictates what the process is going to look like going forward.
And that's exactly the reason why I asked that. Before I asked that, I'm going to do a little plug here. So Brandon does a good bulk of the business for my clients. And the reason why he was saying some agents don't want to order the appraisal right off the bat because there's a cost involved. However, Homes by Kuzi clients that work with Brandon, that's covered for free, just so you know. So you don't have to worry about it on our end. Right? That offer still on the table before I
It
say that?
is.
All right. I don't want
Absolutely.
to,
Yeah, absolutely.
I
Absolutely.
don't want
Yeah.
to edit that out.
Any of your clients that work with us for financing, work with you to purchase the property, we give them a credit toward the cost of the appraisal when they close.
So it's covered anyhow. But the reason why I asked that particular question is because if you're new to this game as a real estate agent, or maybe just don't do a lot of condos, whether you're the buying agent or the listing agent, you got to stay on top of the lender. Make sure that condo questionnaire is ordered quick because not all of them do it. And I'm gonna be honest, not all of them know to do it. There are just like real estate agents. There are also a lot of mortgage brokers with not a ton of experience. So if that lesson alone could save your clients on either end a ton of time and money and them not being mad at you, which is important because we're on a referral based business, right? So you want to make sure you're protecting your client at all times. So Brandon, um, let's get a little personal here. What was a rock bottom moment in your life? And you don't have to answer this, but I'm going to make this a little more vulnerable right now. A bottom money moment in your life, a stressful moment financially that you got out of, and how did that shape the way you give advice to people now when they ask you for financial advice and mortgage advice?
Yeah, it's a good question. Actually, it's funny we're talking about condos because that actually has a lot to do with it. So I mentioned I got in the business in 2002. I worked for a small mortgage company when I first got in the business up until 2004-ish, five. Um, and then I was offered an opportunity to work for a large builder here in South Florida, the Related Group. So Related Groups primarily focused on building condominiums throughout South Florida along the coast,
Yep.
right? So you're somewhere around like Hallandale Beach, Hollywood Beach area, all the way down to South Beach. And so I had an opportunity to go work for a joint venture they had, which handled the financing in the buildings as they were being built for the end users. It was a joint venture between them and Wells Fargo. So I went and did that. And I was there for a few years, but the way that it worked there is you would work on a project, get people qualified about a year out, right? Now, you got to keep in mind these buildings were being built.
Yep.
They weren't done. And so, 2004, good, 2005, good, 2006, good, 2000, but we all know what happened in 2008. And so the first market to really take a nosedive was the South Florida condo market.
Yeah, I
That
remember
market,
that.
right? And so what happened was, and I was a kid, so I'll be 40. Man, how old am I? I'll be 44 in February, so in a couple months.
Okay.
When I was a kid, I mean, what was that, 20 something years ago? I was my 20s, right? And don't know any better, is making good money and using that money. And even the money I hadn't earned yet, right? From these
Sure.
future closings that would be coming from, because you'd have hundreds of closings at a time in these buildings. It's just yet to get to the point where the buildings were completed. So what happened was the last project I worked on was a condo conversion in Bal Harbor, so Miami. And what they allowed people to do at the time was, they allowed someone to buy the contract and they allowed them to resell the contract right? So you'd have a first buyer for this project. Let's just say they bought a one-bedroom condo for 500,000. They give a deposit. They don't own anything. They never took title as an owner. They have the contract for 500,000. This market was on fire at the time, if you remember, like
Oh yeah.
hot on fire, not on fire like good, burning to the ground, good on fire. 6 months later, they'd resell that contract for 800,000. The contract. So now you have another buyer. This person never closed. This person paid 300 grand more. This first buyer made 300 grand, never even owned the property, right? And now this person who paid 800,000 is the person who's going to close on this property a year from that, right? So this is who I'm helping with financing, not this person.
Got it.
So you get to the point where you're closing and they try to close cash buyers first because you need to get comps. So you have your first cash buyer come in, closes at 800,000, let's call it, right? Well, now they need to start closing these finance units. Well, the market, by the time they're ready to close these, now we're talking 2008, the market's completely shifted. This person that paid 800 is paying 800 for a condo that's worth about 500,
Yeah.
right? Because that market just completely took it. Now it's on fire in the other direction. Like it's burning to the ground bad. And so people decided, you know what? I have a 20% deposit with the builder. I know I can take a $160,000 guaranteed loss, right? Or I can take a $300,000 loss on the value of the property. I'm going to go with the $160,000 loss and sue the builder to see if I can get even more of that back.
Sure.
So you had people that decided, hey, I'm not even going to close. So this pipeline of finance buyers in these buildings completely went dry because everyone started deciding, hey, I'm not closing, I'm not closing, I'm not closing, I'm not closing. And so you were talking about rock bottom moment for me is I was still spending money like I was making that money, right? And
You're
so the
you
problem,
have that debt. Yeah, that credit
yeah, I
card debt.
went. So this is now rolling late 2008. I've been engaged for almost 2 years to my now wife at the time, and I was screwed financially. So in early 2009, I filed Chapter 7 bankruptcy. This is before I got married because I'm like, I'm not going to burden my soon to be wife with my debts because I was living off credit cards, right? And just everything you probably shouldn't do. And
The
that I would
man of her dreams.
advise people not to do, right? And so anyway, yeah, exactly right, Chris. And so I ended up filing bankruptcy. And from that point forward, I said, I will never put myself in that position again. And I never have. And so I guess don't put all your eggs in one basket is a big thing I learned there. Just be smarter with your financial decisions. Don't live on money you don't have. I think so. Typically, when I buy things nowadays, I won't buy it if I can't pay cash for it. Not that I'm paying not that I am paying cash for it, but if I don't have the ability to pay it off in cash, I just don't buy it. Also, I can still finance something, right? A car, a home, but I make sure I have the equivalent amount of money invested elsewhere where it's liquid, where if I needed to pay that debt off, I can pay it off.
Very
And
smart.
so, not everyone is in a position to do that. It takes time and a lot of work to be able to do that, right? And it doesn't necessarily have to. Maybe you have your own rule. Maybe your own rule is, hey, if I can't cover 20% of this item, I'm not going to buy it. Right? It doesn't have to be 100%. Everyone can have their own scale for that. But just for your question though, that was definitely a rock bottom moment from where I just kind of start over. Right? I thought I was on top of the world. I was 20-something-year-old kid making really good money, uh, living on my own, right? Was just about to start my life, get engaged. I did start my life, but it was had to start. I think instead of starting here, if this is good, I started here and built my way back
Yeah,
up
but you
over
learned a
time.
lesson, man. You learned a lesson and it made you better long term, right? Would you say would you say that? Yeah,
I think that's it. If everything's always easy, yeah, like you never learn. I think you need to have those experiences to be able to. What do you measure things against,
that's a good point.
right? Like it's like, is your day bad or isn't really not that bad because you've had these other but you need to have the really bad day to know if your day is good or bad, right? What do you need something to measure against? And so if you don't have anything to measure against, which I not that it has to be exactly what I experienced, but it was a good lesson for me, right? And luckily at the time, I really didn't have any responsibilities. Thank God, right? It could make the choice to file and start over where I didn't have children, right? I have kids now, not as many as you, but I have kids now, right? I have a wife, I have a house, I have responsibilities. And so you never want to put yourself in those positions, especially if you do have those responsibilities, right? I think that's the advice I try to give clients and other people that are on my team or that I coach in mortgage origination is just making smarter decisions.
Yeah, you make a good point about living those experiences have taught you have something to measure against because if I'm going to get slightly vulnerable, I go through moments of it'll be like a month or two of extreme anxiety. And I'll do that. That happens every couple of years. And the first two or three times that's happened in my life, I thought I was just like going to die. Like literally, I'm like, oh, there's nothing worse than this. But now, when those weird bouts come through, I go, "You've been through this a few times. Like, this is something just mental. It'll clear, be past, and you'll be like skipping, like, on the yellow brick road in no time, right? So, but you don't, but it makes you stronger and it makes you stronger, makes you more aware, and it make the challenging things in life harder. And it also puts things in perspective. Like, you not getting your ranch dressing at a restaurant's not that big of a deal. You know what I mean? Like, there's other things that are way more important. It's all perspective. I tell my agents this, and often and they don't want to hear it. They'll complain about this, that, and the other. I'm like, yeah, that's a problem. But what if you got in a car accident on the way home? Would that still be a problem? No, not really, because now you have a car accident. That's a bigger problem.
Yeah,
It's all
it's true.
perspective, right?
No, it is perspective. It's funny because I'm reading a book right now called Influence. And so just to give a different observation, and I'm gonna butcher this of what they talked about in the book, but I'll make it as clear as I can make it. So what they talked about was an experiment that was done where they had a group of people that took their left hand and they stuck their left hand. Half the group stuck their left hand in a bowl of cold water. The other half stuck their right hand in hot water. And then what they did was they had those same people each take the hand that was in the hot water, hand that was in the cold water, and put it into like lukewarm water. And so perception, the people that had their hand in cold water previously felt that this lukewarm water was burning hot. The people that had their hand in the hot water before felt that the lukewarm water was cold. The point is they had something to compare it to, but they had two different
Exactly.
things. So that's the point. If you have nothing to compare something to, you don't know what's hard, what's not. So you need the hardship to know if what you're going through is something that you can make it through, which you typically can make it through anything versus not, right? It's all about perspective. And so I thought it was I definitely butchered the way it was explained. That was just a very like Cliff's Notes version, but I
It
think you
makes
get the
sense.
point. You need something to measure against is the point of that.
So that makes sense. So we're running out of time here, and I'm sure you're busy. But I did want to ask. Well, there's a few questions, so maybe we'll do this another day. But there's a lot of things buyers and even sellers should know about lending that they don't. I recently did. Let me give you an example for context. I recently did a reel about the surprises that buyers get when taxes get reassessed. When taxes get reassessed, their mortgage payment typically goes up because you pay your taxes inside of your mortgage payment. And a lot of lenders would always quote, not always, well, I would say a lot of lenders quote buyers what their payment would be today, not realizing when taxes get reassessed, and they will. because that's what happens when you change ownership. Their payments go up. I didn't know that when I first started my career, and actually, when I thankfully I learned it early on from my clients. Like, hey, did you know my taxes went up this amount? I'm like, no, I didn't know that. But again, I was young. I was like, I was probably in
Sure.
my early 20s. But anyways, I'm giving you an example. Is there anything
That's a
else
huge
like
one.
that?
I think that's a huge one.
Yeah, it's a big one.
What you
What
just
else?
said, I said that's probably the biggest one, is that the biggest surprise, and I've done content on that as well, because it's true, right? Just that most buyers don't realize that a lender qualifies you off of the existing tax bill for the property, assuming that it has traditional exemptions, right?
Mhm.
If the current owner is a 100% disabled veteran and they're not paying any tax, well, we're not going to use that tax bill to qualify someone, right? But if it's a normal exemptions, maybe homestead exemption, if it's a primary residence and the new buyer, right, is buying as a primary, we're going to go off that tax bill, as would any lender. But to your point, the taxes will go up the following year once they're reassessed, usually November, right, of the following year. And it's going to be something that's closer to, 1.5 to 2% of the sale price of the property,
Yeah.
realistically. And so that's a big jump. And so I let clients know that in advance. One of the big questions I ask and our team asks when they're pre-approving someone is, well, what's a comfortable monthly payment for you? And so when someone gives us that number, say, okay, I just want to be clear on something, right? This is where we can here's what you can buy today at this purchase price, going to give you this monthly payment. But what's going to happen is a year from now, it's going to be reassessed. That payment's probably going to increase by about $400 a month, right? Hypothetically. Are you comfortable with that change? Because there's ways to keep your payment lower, right? Even when that change happens, but at least want to make sure you're going to be aware of it. And so we try to be upfront about that and explain it's going to happen, put it in writing that it's going to happen because people easily forget. But something that I'll discuss with a lot of people and that we give the option of is waiving escrow. Now, waiving escrow is when you don't include the taxes or insurance or both in the monthly payment. Now, it doesn't mean it saves money, doesn't reduce any bills, but what it does, it prevents a shortage in the escrow account, which is where you're seeing the biggest spike. Because when someone escrows for taxes, for instance, in their monthly payment, and let's just say the tax bill is 500 a month at the time they close. So that's part of their bill is 500. Tax bill goes to 750 a month in the following year. So we're short by $250. Well, here's what's going to happen. The lender automatically is going to have to start collecting the 750 a month from the person going forward. But what they
Yeah.
also have to do is collect the $3,000 that they were short over the last year, right? 250 difference times 12 is 3,000. So what they do is for a year following the increase, not only did the payment increase by the $250, it actually increases by $500
Wow.
because they're going to collect what was short because the lender would have paid it out, and they're going to collect the higher amount going forward, right? That's why there's such a big jump. So I always try to recommend waiving escrow. Someone has to be their tax bill when it's due. But if it's someone that's comfortable, manages their money properly, I think that's important. The other thing I would say that surprises people is that there are closing costs. You know, realtors tend to know it. We know it, of course, as lenders. We talk about it every day, but the things we talk about every day are not things that the average consumer talks about every day. And it's just not common knowledge. And so closing costs are a big one. People think, oh, I need a down payment for a home. Some people don't realize they need a down payment, believe it or not. But let's just say they know they need a down payment. What they don't not aware of is that they need closing costs. And not even only that, even if they do know they need closing costs, oftentimes they're surprised by how high they are.
Yeah.
Especially here in Florida. Florida's pretty high. I mean, we don't have state income tax, but there are doc stamps, right? That anyone taking a mortgage out has to pay when they get a mortgage and buy a property in the state of Florida. And just the title fees are relatively high. And so all those things add up quickly. So I'd say that's a big thing that home buyers are surprised by is the costs on top of the down payment that they're going to incur when they close on a property.
And that's just another reason why you want to get pre-approved before you go looking for property. We're gonna wrap up soon because I have to go get my kid from
Yeah,
daycare. And plus
you're
we've been,
fine.
chat for a while. But I have so much there's so much I want to talk about. But
We can,
I do want to leave 2 points since we're
well,
on this topic. We're gonna. Here's something interesting too. I almost threw away $3,000. So on that subject, if there's an overage on your escrow account, your mortgage company's going to send you a check and it sat. I don't know why. I'm pretty good with my mail, but for some reason this envelope just sat like here, like literally here on my desk for the longest time, and I don't know why. I just never opened it. I just whatever. Anyways, I did open it and it was expired. It was the date the cashier was gone. It was like $3,200 in overage on escrow, and I almost it's like so I had to call the bank and I had to get it reissued, and they were cool with it. But my point is, you might actually get money back. So if
Yeah,
something
that
that you
does
might think is
happen
yeah, if you
for
think it's
sure.
junk mail, don't just toss it. At least look in there. It might be money. And another point that another tip I want to help with is with if you're a seller, if you've been living in your house for a long, long time and you've been paying taxes a long time, you've had our Save Our Homes tax, or at least in Florida, a tax cap, meaning your taxes can only increase so much per year, so you're not just hit with a huge tax bill when values go up. And if you move and you claim that your another property is your homestead before you close on that other house, your tax bill is going to reflect the new value. So you're going to get hit with a bill or a potential bill later of the uh, the difference. So you might like, well, why am I paying all these taxes? Is because you removed your homestead before you closed 4 or 5 months prior to closing, and now you owe that money, that portion back.
Yeah, it's a good point that you just brought up, Chris. I actually ran into a scenario with a client of mine where the home that they bought turns out the seller removed their homestead exemption, but it had not reflected yet because the new tax bill hadn't come out. I think we closed in September, let's call it 2024. Tax bill came out in November of
Yeah,
2024.
it's almost
And
a
so
year.
the title company, when they did the prorated tax collection or credit from the seller to buyer, based it on the most recent tax bill, which still had the exemptions on it. When the tax bill came out, it jumped up $6,000
Mhm.
and it became a whole issue with our buyer having to try to get reimbursed from the seller because that money had not been prorated properly because it was based on a much lower tax bill. So it just opened up a whole can of worms. So what I would say also is if you are a seller of a property that removed a homestead exemption and you're going through the process and the tax bill hasn't reflected yet, you should really be upfront with the title company and the buyers of the property, just like making them aware of that that's going to happen because it can cause a potential lawsuit like what happened in this case post closing if the numbers are big, right? So they were coming after $5,000 in this case in taxes that were really owed by the seller of the property.
And the
So
thing is,
just food for thought.
we don't, as real estate agents, we don't know that happened because it's not reflected in the tax
Correct.
rolls. The title company doesn't know it happened. That happened either. The only people that know that homestead was removed is the seller of the property. If they don't disclose that, and to be fair, a lot of times they don't realize they should disclose it. But it's not one of those things that we automatically assume possibly happened because it's usually doesn't. It's usually not the case.
Yeah, it's not common
Yeah.
practice.
Not at all. It's not something you see one out of every. You saw 100 homes, you may see it a half a time, not even once, right? But it does happen. So I thought that was a good thing to share. All right, my friend, we got to wrap up. I'm getting a high sign from my wife over there. Got to get my baby. You got to get to your wife and your kids. Great chat as always. We need to do
Yeah,
a part two
yeah,
of
it was great
this.
talking to you, Chris.
Brandon, if someone wants to get a mortgage from you, where do they find you?
They can just go to, for one, if they're on social media, brand the mortgage man, BRAN the mortgage, MORTGAGE man, Instagram, TikTok, YouTube. That's really the best place to find me and the easiest place to get in touch with me.
That's where I want to. That's where I want to go. Our next conversation. I want to talk all about your strategy and marketing strategy because I love it and we're aligned. All right, my friend. I will see you later. I appreciate
All
you.
right. Talk to you soon. Thanks, Chris.
Bye.
Bye.
All right.